and welcome to our class on retracements and reversals, sponsored by Legacy FX and investing.com. Now, Legacy FX is one of the world's leading providers of CFD and Forex trading, and they're a fully licensed and regulated Forex broker, and they offer 4 different platforms. You can use their MetaTrader 4 platform, their Xerox Station, their mobile trader, or their web browser, which is one of the nicest, easiest to use online trading platforms. It's easy to see, it's easy to read, and it's easy to find what you need to trade successfully. Now, Legacy FX is one of the leading providers, and that's only because their philosophy is simple. They offer focused and personalized service that makes trading logical. Legacy FX cuts through the excessive jargon and provides financial content in a language that is comprehensive to all. We break down important financial data and explain it in terms that even novice traders can understand. And through their belief in education, you can become a more successful trader. They have easy deposit and withdrawals. They have the Legacy FX Pros category. You can get ultimate security when you're trading and enroll in their trading academy. Now, since Legacy is a regulated provider, I need to provide you a risk warning. So I'm going to read the first paragraph, and I would appreciate it if you could read the rest of it. Spread bets in CFD are complex instruments and come with a high risk of losing money rapidly due to leverage. 76% of retail investors' accounts lose money when spread betting or trading CFDs with Legacy. You consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Legacy Forex provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. Now, tonight's class is being recorded, and if you wish to see a recorded version of tonight's class, simply use the same link you used to attend tonight's class, or when they have had time to edit it, you can find it on investing.com under the Education tab and look for Webinars on Demand. Now, also tonight, I'm going to be showing you a couple short presentations, and to see those presentations, I've just popped the link on your screen. You can see them anytime you want on this link. Just look, when you go to the playlist, look for retracements and reversals, and you can find the presentations I used in tonight's class. Also, on your screen, you should see 2 handouts. One is called Retracements or Reversal handout, and that's a short guide that I put together for you that will give you all the information we've had in tonight's class, and also an introduction to technical analysis. Now, these 2 handouts are only available now in this class. You cannot download them from the recorded version. They're not offered anywhere else. So please click the download button on your screen. Download them to whatever device. They're just PDFs. Just download them to whatever device you are using, and then you can transfer them over to wherever you want them later. But it's the only way you'll be able to access these. Now, in tonight's class, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, Forex, CFDs, and cryptocurrency. Now, while I may imply a specific investment product, like I might say Bitcoin, or I might say the euro, I might say gold, we're all talking about the same thing. It just gets very boring saying security, security, security. Similarly, I intermix the term investing and trading. And over the years, I've gotten a lot of relatively nasty emails saying, "Imbecile, don't you know the difference between trading and investing?" Yeah, I know the difference. And since most of us are here tonight attending class because we're interested in trading CFDs or Forex, we are traders. But it gets very boring just saying trading, trading, trading. So we understand that investors usually take a long-term position in something to hold and acquire and to hold as long as they want. Where traders take a much shorter term position and are looking for short term asset movement. But in either case, the basic concepts and techniques presented in this class are equally adept. Now, don't we all want to ask, should I buy today? What will the prices be tomorrow, next week, next year, or in the next 2 hours? Wouldn't investing or trading be easy if we knew the answer to these seemingly simple questions? Now, yes, if we look in the market, if we go online, if we look in the internet, we see lots of gurus out there pounding their system, telling you how much you can make and how fast, and if you do this and do that, you'll know exactly where that asset will be. Well, the fact is, I don't have a crystal ball. I don't have a Ouija board. I can't tell you where an asset's going to be an hour from now, tomorrow, next week. And unless if you're attending this class in the hopes that technical analysis will answer these questions, I'm afraid I got to disappoint you early. It doesn't. But the fact is, if you're attending this webinar with the hopes that technical analysis will improve your investing, I have good news for you. It sure will. But ultimately, it comes down to risk management, money management, and having a good strategy and excellent knowledge and education. So tonight, we're going to be talking about retracements and reversals. So let's get started. Now, spotting them. The ability to point out the difference between a retracement and a potential reversal is a great tool to add to your trading arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between asset retracement and a potential reversal. This is why the focus of today's webinar is to provide you with the information and knowledge needed to accurately determine whether an asset trend is forming a retracement or preparing for a reversal. But ultimately, it's really sometimes very hard to outsmart price action. We might see a retracement and it can very easily become a reversal. But there are techniques that we can use to understand these and help us in our trading. Because all of us know, or hopefully we do, that assets move in three directions. They can uptrend, they can downtrend, or they can move sideways. Whether they're uptrending or downtrending, a trend should move in a push, ease, push, ease, push, ease. Or ultimately, you hear about making higher highs and higher lows, higher highs and higher lows. Or the peaks and the valleys. But assets don't move this way. They move in well-developed, well-formed, hopeful trades. And the more well-formed that trend is, the more we can successfully trade. And there are ways to predict these retracements. And knowing how that retracements occur, and knowing that a well-deformed trend is making higher highs and higher lows, will keep you from panicking, will keep you from jumping out of a market that is a very good trade. And it'll also help you get from getting in the market at the wrong time. So let's start off with some general definitions. Retracements are momentary reversals that occur during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset price action. As you can see in the picture below or to the left here, there are a couple retracements that take place and occur throughout a prolonged period of time. Reversals are temporary changes in the asset's trend that occur over a short period of time. Oftentimes, the reversals can last minutes, hours, or a day. It just depends on what time frame you're utilizing for your trading. Reversals are often sometimes dramatic and do not represent a long continuation of an opposing trend during an asset price action that may be mixed up for a retracement. So you can see the examples of what a reversal looks like on my chart. Okay. Now, Wall Street is chock full of investment idioms, and perhaps none is so broadly quoted as cut your losses short, and let your winners run. Well, this is easier said than done. But how, in fact, is an investor to know when an asset is merely retracing against an existing trend or if the trend is outright reversed? Successful investing is predicated on knowing the answer to this question. Now, in my chart over here, we can see some general rules, but unfortunately, they're hard to apply. Okay, there are some ways that we can spot or we want to understand whether something is actually reversing or retracing. So if we look at volume, okay, profit taking by retail trade, another small blocks of trade, we can think or get understanding it might be reversal if we say big blocks of trade through volume, because that's the institutional selling off. We can look at money flow. Chart patterns can help us. Shorting interest, time frames, fundamentals. If there's been no change in fundamentals, it's most likely a retracement. If something has happened in the market, most likely it could be a reversal. And of course, we have certain candlesticks that'll help us. Indecision candles like spinning tops, or reversal candles like engulfing or soldiers or other similar patterns might show it's a reversal. Now, whenever a price reverses, most traders and investors are faced with a tough decision. They have three options. One, to hold through the sell-off. Two, to sell and rebuy if price recovers. Or three, to sell permanently, okay, which can mean miss opportunities when the price recovers. Because remember, we are looking not to panic sell and jump out of a market. We're looking to let our winners make as much profit as possible. So by properly identifying the movement as either a retracement or reversal, you can reduce costs, limit loss, and preserve gains. So I'm going to share a quick presentation with you that'll show you this in a little bit easier fashion than all my words, in a better graphic fashion. And then we'll come on and look at more defined definition, or we'll look at charts to be able to see these actually occurring. Now, we do have a class on Fibonacci. We have another class on support and resistance. These are things you have to learn and master. And it takes me more than just, combine this class. We have a 1 hour class on just support and resistance. We have a 1 hour class on just Fibonacci's. But traders have an expression for attempting to pick a market top or bottom. They call it trying to catch a falling knife. Because as the expression implies, it can be downright dangerous and is not normally recommended. Okay. We'll never be able to pick the top and the bottom. What we're looking for are healthy trends, okay, and understanding why a trend is moving in the way it is. So let me pop up a chart on your screen. Here's a live chart on the Euro US dollar. We're looking at a 60-minute chart. Now we see, let me get my chart back up here. Sorry about that. We see that when price is moving down in the downtrend is over, push, ease, push, ease, push, ease, push, ease, push, ease. Because in a downtrend, we're looking for lower highs and lower lows. In an uptrend, push, ease, push, ease, push, ease, push, ease, push, ease. Okay. When it stops that, what do we get? We went into a reversal. Okay. A trend line will help us see the pushes and eaves. But in these pushes and eaves, we're looking to make higher highs and higher lows. In other words, each one of these lows was higher than the previous low, or these valleys. Now, in order to move an asset, it takes a lot of work. In order to push an uptrend or a downtrend, okay. Hold on, let me get my marker back now. Okay, this is a lot of work to push a price this direction. So price will move up, okay. And at some point, what you have is buyers, 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 buyers buying. Okay, at some point, what happens is the market's still moving up, but a group of the buyers, or a good deal of the buyers, say the price is getting too high for me to enter the market. They're not saying it's not going to continue up. It's just too high for them to enter the market. So they're just going to move to the sidelines and sit over here. Another group who entered the market around here or wherever they entered with a long position have already said, okay, they've looked at their charts and say at this resistance, they've already put a take profit point. They're selling because they've taken, it's made the profit they wanted to make for the day. So they're happy. They've made their pips and they're selling only to get out of the market. They're closing their positions. Okay. When they close their positions and at the same time this other group of buyers are sideline, the price will start easing down. Okay. At a certain point, these buyers over here, well, first of all, these sellers are all cleaned out of the market now. And these buyers over here that were sideline are saying, okay, that price is getting low enough. We're going to start entering back into the market. And they start pushing the market back up. Okay. Now, no fundamental factors have happened. No world-changing events have happened. Nothing has changed except the psychology of the market and price. Okay. Now, whether it's a retracement because it's hit a resistance level, whether it's hit a Fibonacci level, whether the RSI is broken over 70, okay, we don't know. Everybody's using their own different strategies. But this is what makes a well-developed trend. But the fact is, we will never, okay, if we're following the rule of trade with the trend, we're never going to get in here at the very bottom. We're never going to get out here at the very top or up here. Now, we could sit here all day long crying that we only entered the market here and we got out somewhere around here. We didn't get out there. We didn't make the maximum profit because there's no way to predict that. There's no way to do. Now, maybe RSI or stochastics and MACD said the markets became overbought. But if you notice, this trend didn't reverse. It continued in its same trend pattern. In fact, it honored this trend line extremely well. So there is very limited ways to say that was the top of the movement. Except after the fact, you're sitting here kicking yourself in the head, saying, oh, look at that. I could have made this many pips instead of that many pips. But it's very hard to predict. The fact is, you don't want to either panic sell when the market eases down or get out too early. Now, this would not have been too early, but this would have been too early. So understanding how these happen and understanding that the push and ease, the push and ease, the push and ease, these retracements are valuable parts of a trend. But understanding when they are becoming reversals is important. Now, at this point here, when they were really respecting that trend line, we would have expected this trend to really continue upward, but it petered out entirely right here. But look at that. Once it started breaking that trend line at this level, that would have given us some clue. Okay. We can see on here, now, these are my two standard teaching charts. So these lines, the red and gold and blue line, these are levels of support and resistance that have been drawn on here and brought forward for a very long time. And they're very, very good levels of support and resistance. We can see that as price came down here, okay, it broke right through all the resistance levels, okay, with no problem at all. Now, it's fallen down so low that I don't have the new support and resistance levels on this level, on this price, but we could have been looking at this. This becomes a true reversal as it is a retracement. How could we have ever noticed this? Okay. How could we have ever been able to predict this? Okay, because if we look at the longer term chart, we could have seen a downtrend, and this is a continuation of this downtrend. Okay. So let's go back to my PowerPoint and let's talk about how we might be able to pick these out in reality. Now, retracements, remember, as I've been saying over and over, are healthy. The market in general can become tired of moving in the same direction. It takes a lot of work and money to send an asset higher. When the price gets too high, buying pressure runs out when the money dries up. When the demand dries up, prices begin to fall and cause the chart to head south. This causes security to become more appealing to prospective buyers who believe the stock or the asset has the potential to move higher, but we're waiting for a better opportunity. As the price becomes more appealing at a lower point, these new buyers step in, creating demand, and once again, the price begins another leg higher. What I've just described is the retracement. Now, you can see that after the retracement, the asset was unable to push to a higher high. So in other words, the market retraced, but it wasn't able to push and make that ultimate higher high. It didn't get back higher than it was before it retraced. So instead, the security rolled over and created a lower high. The lower high is unhealthy, but is not the end of the bullish trend. It's possible that after setting a lower high, the asset could retrace again, never setting a lower low, and then push above the previous high to establish a higher high. But the nail in the coffin of the bullish trend is the establishment of the lower low. Once the lower low is in place, your trend is over, and we begin to call this a reversal. So remember what I said, and I showed you in the chart: higher highs and higher lows in an uptrend. The minute you make a lower low, we know we have a problem. So let's add some guidelines. Reversals are defined as a change in the overall trend. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal also occurs. When faced with a possible retracement or reversal, you have three options. Okay? If in a position, you could hold on to your position And this could lead to losses if the retracement turns out to be a longer-term reversal. You could close your position and re-enter the price if the price starts moving up with the overall trend again. Of course, there could be missed trade opportunities if the price sharply moves up, or money wasted on spreads. And the reason we don't want to just, I mean, it's easy to say, okay, every time the markets push up and then eases back a little, close out your position, and when it hits, when it hits the trend line or support line, you can get back in the market again. But the fact is, each trade is costing you your spread, both the buy spread and the sell spread. So ultimately, you're costing yourself money because you want to stay in the market, not make duplicate trades because you're losing all those points. So if you got an 8 or 10 point spread and you're buying and selling, each time you're losing 20 points, well, you're losing that whole retracement. So you're better off staying in the market, except when it becomes a reversal. So you could just permanently close. This could result in a loss if price went against you, or a huge profit if you closed at the top, depending on the structure of your trade. Because reversals can happen at any time, choosing the best option isn't always easy, but you should be prepared. Now, here are the most popular tools, the popular techniques you can use. One is Fibonacci retracements, pivot point support and resistance levels, trend line support and resistance levels, chart patterns, and my favorite is eyeballing support and resistance. It's going back historically and looking for crucial price points or crucial levels where pricing congested before. Now, we showed you briefly on the presentation about Fibonacci retracements. Now, Fib retracements are an excellent tool for calculating the scope of a retracement. They are most widely used in the Forex market, but also used in the stock market. To use them, simply use a Fibonacci tool. Pivot point levels are also commonly used when determining the scope of retracements. Pivot point levels are support and resistance levels that are done by a calculation. You can get a pivot point calculator just about on any technical analysis site, like investing.com, or you can go directly to a pivot point chart. And it's going to give you the 3 levels of support and resistance above and below the current price. And trend line support and resistance. Finally, if a major trend line supporting the larger trends are broken on high volume, then a reversal is most likely in effect. Chart patterns and candlesticks are often used in conjunction with these trend lines to confirm reversal. Remember, we were looking at the trend on the euro-US dollar. Okay, we saw it break that trend line support level. So you can draw a retracement over the tops or the swing highs and a support trend line throughout the bottom on the swing lows in an uptrend. Also, chart patterns, especially triangles. Chart patterns have an established definition and criteria, but there are no patterns that tell us with 100% certainty where an asset is headed. After all, the richest man in the world would be a trader in this case rather than an investor. The process of identifying chart patterns based on these criteria can be subjective, which is why charting is often seen more of an art than a science. So like a head and shoulders pattern is a reversal pattern, where a triangle is neither. It's showing us pent up demand and telling us that a breakout should occur. So let me see. I think I have a chart up here that's showing you a triangle pattern. Let me pop up my chart here for you. So here on the U.S. oil, we're looking at, let me get the moving averages off of here. We're looking at a trend channel moving up. We have our support and resistance level, and we have our uptrend line here, the red. We have our gold uptrend line in the bottom. We have a resistance level and our support level, and we're using these in conjunction to determine whether we're looking at retracements or reversals. So in other words, as the price movement push, ease, push, ease, push, ease, push, ease back down directly under our trend line. Actually, at the same point, validating our trend, that's 1 touch, 2 touch, 3 touch, pushes one more time, and then it falls down and breaks right through our trend line and breaks through our support level. And what do we have? We have a hardcore downtrend. So we had a full reversal there. Here we have a falling wedge pattern, and we see price break out from the downtrend line and break below it and move in a continued down pattern at this point. Here we have a beautifully formed triangle. So push, ease, push, ease, push, ease, push, ease, push, ease, push, ease. But we're just and ease are getting smaller and smaller as they're moving into the apex of the triangle. And unfortunately, chart pattern triangles don't tell us whether it's going to break down or up. It just tells us the momentum it's going to have. And in this case, it broke down. Okay, so we had a breakout, and the breakout was down. Now here we see the beautiful push, ease, as we're developing a triangle, but we're also seeing a well-developed trend. Okay. So two of the most popular chart patterns are reversals and continuations. A reversal pattern signals that a prior trend will reverse upon completion of the pattern, while a continuation pattern signals that a trend will continue once the pattern is completed. These patterns can be found across many time frames. Now remember, technical analysis is a study of historic price performance in an effort to predict future price performance. Price is the only accurate measure of investor sentiment. It is the intersection of supply and demand. Investor sentiment is at least and possibly a more important determinant of price than fundamental factors like earnings, revenue, profit margins, and economic events. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental changes. And third, the relationship between price and time is linear. This is why a stock price moves can be viewed on patterns on charts. Different strategies have different degrees of success depending on where the market is in a bigger time frame. So a lot of times that time frame is ultimately important, because if all of us are most likely dealing Forex or CFDs is short term, and we're looking at 15-minute and a half-hour charts. To try to determine where you are in a retracement or reversal, you could use larger time frames. So if you're not sure what's happening in a half hour and is it a retracement or reversal, moving to a 1 hour or 3 hour chart, you might be able to see where it is in that longer term trend and determine where it is in the retracement or the pattern that's seen in that longer term chart. So technical analysis of a strong uptrending market will show that basing patterns are frequently broken to the upside, forming a stair-step chart, push and ease, push and ease. This is a strong chart pattern in a strong market. Triangles are among the most popular chart patterns used in technical analysis since they occur frequently compared to others. The three most common types of triangles are symmetrical triangles, ascending triangles, and descending triangles. Symmetrical triangles occur when two trend lines converge towards each other and signal only that the breakout is likely to occur, but not a direction. So what is the symmetrical triangle pattern? Simply put, it's a pattern that enables you to buy into the correction and sell before the pair peaks again. In order to identify symmetrical triangles, we must watch for unique yet symbiotic conditions. Of course, as with any strategy, including symmetrical triangles, there is no singular perfect strategy. It can always guarantee profit. The major downside of symmetrical triangle strategy is the pattern does not occur every time. For example, in waves that follow, we can see there were no lower tops. I'm sorry. That means that the symmetrical triangle is a low frequency strategy. Naturally, that means you can rely on the strategy alone for profits because it takes many times between each opportunity. So remember, keep calm, enjoy yourself. Always look at volume, chart patterns, time frames, fundamentals to see whether you're getting a false signal or a positive signal. Even a retracement that meets all the criteria outlined in our table may turn into a reversal with little warning. The best way to protect yourself against such a reversal is use stop loss points. So here you can do this. You can estimate retracement levels using technical analysis and place your stop loss point just below these levels. An alternative is you can place a stop loss just below the long-term support trend line or moving average. Ideally, you want to do is lower your risk of exiting during a retracement while still being able to exit a reversal in a timely manner. So in conclusion, as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon and missing opportunities, holding on too long and on losing position or losing money and wasting money on commissions and spreads. By combining technical analysis with some basic identification measures, you can protect yourself from these risks and put your trading capital to better use. So understanding how a trend works, understanding the pushes and eases, and one of the best ways to identify a retracement or a reversal is understanding candles, engulfing candles, reversal candles. They will help you understanding support and resistance levels and understanding Fibonacci retracement tool. And we have a class on each one of those subjects so that we spend an hour intensifying. In the handout I gave you under Introduction to Technical Analysis, we cover all those. In the handout on reversals and retracements that I gave you, we'll look at many different ways to identify these reversals and retracement patterns. But remember, lower lows, higher highs, and higher lows in an uptrend, lower lows and lower highs in a downtrend. And whenever you see the opposite, a higher high or a lower low being made in the opposite trend, it's signifying that something is out of whack. Okay. So thank you very much for joining us tonight. If you want to learn more about retracements and reversals, go to Legacy FX. It's www.legacyfx.com and open a demo account, sign up for the education program. There's no charge for it. And use their videos, their ebooks, or you can get some personal help one-on-one from a financial advisor. So again, www.legacyfx.com. And you can watch this class again by using the same link you used to come to tonight's class in about 24 hours. Have a very good night now. Thank you for joining us. And I hope I gave you some food to think about tonight and some interesting ideas to watch the trends and price moves on your charts tomorrow. Thank you very much and have a good night.